Good day, fellow investors. A question that I often get is why I just don't invest in the S&P 500, stocks just go up, you put your money there and you forget about it, make your 10% per year and no worries. Or even better, why don't I invest in the Magnificent 7, Google, Amazon, great businesses dominating out there, and then I get to great returns. And in this video I want to discuss why I remain a value investor, why I think that value is the best investment strategy over the investment life cycle of a person, and why these Magnificent 7 are risky from an investment standpoint. And if you look at the Magnificent 7 now, those companies have almost a 30% share of the S&P 500, which is insane. Plus, if you look at the valuation of these companies and you compare with the country weights of Japan, France, China, UK, the weight in the world index because of the market capitalization is higher than countries like China, France, Japan, UK put together. And if you look at valuation, the Magnificent 7 have a P ratio of 33 on average, forward price earnings ratio on growth, of course. The remaining are around 22. But let's quickly discuss these Magnificent 7 just to give you an overview of what an index has, because the higher these stocks go, the higher is the exposure in an index. Thus, if you buy the S&P 500, you buy more of these compared to value investing. If we discuss Microsoft, let's say that I want to make 10% a year, thus I want to double my money in 7 years. Let's assume that Microsoft's price earnings ratio will normalize over time. It happens with growth stocks. So the current earnings per share of 10 needs to quadruple to 40, that then multiplied with the P ratio of 20 gives us a stock price of 800, so that I get a 2x on the current price. Will Microsoft's earnings quadruple over the next 7 years? Unlikely. Will the P ratio revert? Usually that happens, and Microsoft has been in such run-ups and then stagnated for 10-20 years, because it's likely that this will change over time, or even if it doesn't change, the risk is too high for value investors, no matter the prices. Apple, price earnings ratio of 31, and call me crazy of being a value investor, but this is an article I wrote on Seeking Alpha, March 30, 2016, where I discussed how Apple's P ratio was 10, how it is a buy, and the price went from 27 to the current 193. But again, Apple, the risk there. Slow year, 50 billion in profit, which is still great for a business. P ratio 20, we are down to 1 billion market capitalization, which is where it was a few years ago, and thus too risky now. NVDA, huge growth, explosion. Some of you make 100 times your money on this one, but if I look at revenues, okay, now there will be 80 billion, which is in line with Apple's profit. So sooner or later, this will stabilize because of competition, because of their very low capital investments. So they are enjoying now, but everyone is after them. If I want to double my money here, let's say they 3x their revenues in 7 years, revenues 240 billion. Let's say they make a 20% net profit, that's 50 billion. Thus, to double my money, to go to 3 billion from the current market cap, they still need a P ratio of 60 in 7 years, with the ups and downs of the cyclical semiconductor industry. Too risky for me. Amazon already a little bit better. I told you it was a good risk and reward buy when the stock was 90 just a while ago. Now it is already much higher, and the thesis there is that the revenues double to 1 trillion. Let's say that they make a net profit margin of 7%, that's 70 billion, and then if the P ratio is 40, okay, this doubles and you make money. If the P ratio is 20, this is 5 to 10% down in 7 years, which is again too risky. Google, P/E ratio of 28, better than the others, but the estimations there are that earnings will just keep on growing 26%, 16, 15, 13, and I don't like these estimations because these estimations are static and don't imply recessions here and things like that. The revenues even growth a little bit slower than earnings, 8-10%, and likely earnings will follow. But then again, too risky at this P/E ratio, and you never know how the new tech will get their AI and maybe even take some money out from Google's pocket, as it will happen pretty soon with Facebook. We discussed this, made a video, told you it is too cheap at 99. We are now already at 381, which is crazy for the same business. They focus now on pleasing Wall Street, that's why the stock is out. But attention is shifting from Meta to other platforms, and that will also soon be reflected in the business, and therefore this is a terrible investment, but a big part of the S&P 500. You can also check my last Meta video where Facebook is lying about their membership. Tesla, car industry, if we go into a recession, this is too exuberant for the potential. So, of course, now investing in the Magnificent 7 is too risky, even with the S&P 500, but even 5 years ago, to me, it was too risky because you never know who of these businesses will win, will beat everyone else, and this is just survivorship bias. You see the top businesses that are here now doing great, but when Apple had issues in 2016, it wasn't that clear that someone else will not win that game. And that is the difficult with growth investments. If it doesn't happen, the growth, the expectations, then it gets very, very ugly. And yes, stock give 10% on average, 6.9 plus 3% inflation if not adjusted. Here it is adjusted, so 10%. But you have to understand this is an average. We have had in the 2000s, after the dot-com bubble, 12 years of zero, 1970s, 17 years of zero, 25 years of zero, and we are already in 2 years of zero for the S&P 500, and that is what will likely continue, and especially real returns will likely be negative going forward. And why I don't invest in the S&P 500, I started investing here, and if I invested my 5,000 back then in the S&P 500, now I would have with dividends 25,000. I did differently. Of course, I was a little bit lucky that I invested in a frontier market, made 5x here, then lost a little bit here, then made 4x here, and then maybe 2x again here. So I made 20 to 30 times my money over time. So let's say 30 times compared to the S&P 500, I would still be a poor boy if I invested in an index fund. So I prefer to look at value to protect my downside, because the S&P 500 crashes, as it has been the case here 50%, here 50%, and here 50%. Or it does nothing for a long period, so this is 20 years in a 200-point range. And if you look at the long term, the life cycle, when does growth outperform value investments? Of course, we had the after pandemic, growth did greatly. The dot-com bubble, growth did greatly before the Great Depression. But in general, you can see more blue here, which means that value investment does better over the long term, over the life cycle. And here you have the Fama and French returns, and you can see that small value is on top. Small size is also what matters, so not buying the biggest companies like the Magnificent 7 of the S&P 500, buying smaller companies, buying value, big value, and you have here small growth stocks, big growth stocks usually underperform over time because of their valuation. And of course, now the Nasdaq did amazing over the last 15 years. This is a 7x, but I don't know whether it will do the same again. Likely not. And chasing these strategies, you need to really understand which one will boom in that year, but in the aftermath of those booms, it doesn't look nice. I prefer companies that will be there forever, that are essential, that are cheaper, and then let's say that this goes down, Archer Daniel Midlands that we just discussed, and stays down for 2 years. I reinvest the dividend, I buy each dividend more, my paycheck, and if I just 5 times in a lifetime nail some great opportunity, that really changes everything compared to just buying the most expensive things that look great now because they did great, and they might do even better over the long term, but when the crisis comes, that is where those accumulation, the dividends, the reinvestment give you a great return over the long term. And these are great businesses, the Magnificent Seven, but not at these valuations. And over time, it gets tricky to compound wealth at these valuations. And that is always the problem with growth stocks. Great businesses, high prices. Value investment gives you value every time, the dividend, and I prefer that, and I prefer slow and steady. Sometimes you get lucky, like I got in the past, and you cannot get lucky with an index or by buying the greatest stocks out there. Therefore, if you just get lucky a few times in your lifetime, that difference is what gives value investment the advantage. And I firmly believe that over the next 20 years, again, value investing will have its rough patches like it is having now, given the great performance of the Magnificent Seven, but exactly when there are the rough patches, it is the best time to double down and then just do investing. Value investing isn't sexy, isn't nice, but it delivers over time. That's why I'm a value investing. That's why I'm not investing in these crazy stocks. That's it.